Hey everyone, I'm going to be walking you through my real estate portfolio acquisition model today. This model is just 6 tabs and it's made to roll up the cash flows from a portfolio of 2 to 30 properties. And so it assumes that you've modeled your cash flows before financing either in Argus or in an Excel model. You can pull one of the free Excel models off of our website, and that you've modeled those cash flows elsewhere. You then pull those cash flows in. I'll show you how I do that into here, and then this will roll those cash flows up and will give you some portfolio level metric. The model will also allow you to see property level returns both on an unlevered and a levered basis. It'll also allow you to see how financing affects your portfolio. So let's go ahead and get started. This is a hypothetical model. I modeled out 4 retail properties, and we're going to go right now and pull those retail properties into this model, and then I'll show you the 3 input tabs, how those inputs move through our 3 module tabs, and then we'll take a look at the outputs and give you a feel for how this model is working. And then if you want to manipulate it, change it to your needs, feel free. And so in terms of the cash flows for the property specifically, what I did is I modeled each property in Argus. So I dropped in the rent roll, I dropped in my expenses, my reimbursement method, my market leasing assumptions, and I come up with a cash flow statement, right, for a 10, 11-year analysis period. And then I pull up the cash flow statement in Argus. I export that to an Excel tab. And now I'm going to pull those 4 Excel tabs, the 4 cash flow statements from Argus, over into this model. So let's go ahead. I have that in my other screen. Let me do that right now. 1, 2, 3, 4. So I pull these tabs in here. And now we have 4 properties. The first here is Main Street Retail, and you'll see here, this is just the export from Argus. We have an effective gross revenue line. That's the first line we need. We have a net operating income line, and then we have a cash flow before debt service line, or a cash flow from operations. So if you notice, I modeled up to, but not including financing. And that's what we're going to need to roll this up. And then we look here, we have our second property, 110 Broad, our third Hollybrook Town Center, and our last Klein's Power Center. And this portfolio makes up the hypothetical portfolio that we are calling Orlando Retail. And so where you're going to start is once you've brought those cash flows in, we're going to go to the portfolio summary tab here. We're going to go ahead and put the portfolio name in. This is Orlando Retail. It's our first step. Next, we are going to choose the purchase price method. Now over here to the right, I have an instructions box, and that's going to walk you through the different types of purchase price method. It's a drop-down menu here, and we have a portfolio level, a property level, a DCF value, a cap year 1 NOI, and a replacement cost. Go ahead and read through here the type of purchase price method. I'm going to choose the property level, which is essentially I'm going to set a value for each property, or a purchase price for each property, and then that will sum the 4 properties up, and that will get us a portfolio level price. But you can also set, for instance, here portfolio level. That will open these cells, and you can just drop a one large number for the entire portfolio. You can also do DCF value, which what this does is it takes the DCF value that's going to be calculated based on this discount rate, and it will set your purchase price to be that value. You can also cap your 1 portfolio NOI at this market cap rate for year 1, and that it would then be your purchase price. And finally, you have a replacement cost, which is essentially it would take this dollar per square foot, multiply it by your net rentable area, and that would be your purchase price. But again, for this scenario, I'm going to choose property level, and you'll see when we add in the property assumptions how I add a purchase price for each property. I have an analysis start of January 1, 2016. I have an analysis period of 10 years. So you have to make sure when you're modeling your property level cash flows in Argus that you have an analysis period at least equal to your analysis period and or your exit cap, whichever is higher, right? Your exit cap year, whichever is higher. So we have this analysis period. Let's throw 10 years. It's pretty standard. And then we have an exit cap year. What this is asking is, in what year's NOI do you want to use for your terminal or your residual value? I think default would be the year following your exit year. So this will actually automatically calculate 1 year after the end of your analysis period. But if you want to change this, you can go ahead and change this to 10 if you want to cap the year that you're exiting. But again, I'm going to keep this as year 11. Then we have an exit cap rate growth per year. Now, how I calculate or determine the terminal or the exit cap rate that I use is I take my year 1 market cap rate. Think of it, if this is a stabilized asset, as my going in cap rate. And then I'm going to add a certain number of basis points to that cap rate each year so that at the end of the analysis period, I've grown my going in or my market cap rate in year 1 by a certain number of basis points, and that's my exit cap. You can adjust this around some, but that's how I do it. So I'm going to first set my market cap rate for year 1. I don't know what this is going to be. You know, in the real world, you'd have market knowledge, you'd have some guidance from brokers and the like, and you'd have a pretty good idea of what your market cap rate is. In this scenario, actually, because we're using property level purchase method, we're going to have a pretty good idea. Right here, you see you have going in cap rate. We're going to have a pretty good idea of where the market cap rate should be in year 1. For now, I'm going to add a filler of 6.5, and we can come back and address that so that we can determine how much do we want to grow this market cap rate to exit. Because generally, your exit cap rate on a stabilized acquisition like this, your exit cap rate is going to be higher than your going in cap rate. So I'm going to add 5 basis points per year so that in year 10, which is when we exit, 10 times 5 is 50 basis points on top of our 6.5 going market cap rate. So our exit cap rate in this scenario would be 7%. Next, we have our discount rate. I'm going to put 8.5%. Now, your discount rate, there's a couple different ways of looking at this. I typically think of discount rate in terms of either opportunity cost, right? So, you know, what do I expect my money to earn? Maybe call it cost of capital, whatever. Another way to look at it is this is the unlevered return that I would like to realize on this investment. Again, I'm going to throw in 8.5%. And this number here then is going to determine our DCF value here, which is not our purchase price because we're using a different purchase price method, but it's a pretty good idea of helping us see what do we think this property's worth versus what are we actually paying for it. And you can then take it the next step if you'd like and come up with your NPV value. So next we have here the last input on this portfolio summary tab, replacement cost. This again, because we're not using replacement cost purchase price method, you know, it's more for if you want to see. Obviously, the replacement cost is going to vary by market and by asset, and so in this hypothetical scenario, I don't know what the replacement cost might be. I'm going to throw in $250, but more than anything, it's so you can see how does the replacement cost down here, the total replacement cost. How does that compare to what I'm paying for it versus what I deem the DCF value? Perhaps we're buying this under replacement cost, which would be a good thing. Perhaps we're not, which isn't necessarily a bad thing. And so that's where this is. This becomes more important, though, if our purchase price method is to use the replacement cost method. Okay, so now that we've filled in kind of the high-level portfolio assumptions, we're going to ignore these other items until we finish inputting the rest of the information. So we're going to go to our next input tab, which is here the property assumptions tab. Now, this tab is where we put all the property level information, and I'm just going to get right at it. I'm going to start with our Main Street retail, which is in Orlando, Florida. This property has 219,000 square feet. It is 89% occupied. The guidance we've received from brokers is that it's going to trade at about $48.5 million. Again, on all my models, you only edit cells that have blue font. So if you start editing these other cells, that's going to change, obviously, your calculations. Now, feel free to manipulate anything in the model, make it your own. But do know that if you start changing these non-blue cells, these non-input cells, that's going to break the model. And so make sure that you know what you're doing before you start doing that. Then we're going to drop in an acquisition cost. Now, the acquisition cost does not include your financing costs. So I think of acquisition costs like, hey, what's my due diligence on this? Do I have to pay maybe in-house staff, an acquisitions team, some sort of bonus for the acquisition? Perhaps there's closing costs or escrow fees that are involved with the acquisition that myself as a buyer am going to have to cover. So in this case, I'm going to call this acquisition cost 0.5%. Okay, so now we have that. We're now going to move into our financing assumptions. So first we have interest rate. There's a couple ways of looking at this. You could either have a loan on each individual property where each property has its own specific terms, or you might have a cross-collateralized, cross-defaulted loan where the loan is covering all of the properties in the portfolio. We're going to assume that it's the latter, and we'll keep the same terms for each of the properties. It's got 3 years of interest only. It's got a 30-year amortization period. A 10-year term. Now this term here, this model does not calculate prepayment penalty, so the term is more visual than anything else. It's to help you see perhaps there is a prepayment on here, and you'll need to come in and model a refinance, which this does not do. You at least, if you can see what the term is for each property, that'll help you then plan for that. We got LTV, I'm going to call it, in this case, 65%. Next, we have upfront CapEx. So let's say you have some lease up or you have some deferred maintenance that you need to cover on the property. If you have not modeled that already into your Argus cash flows or the cash flows that we pulled in, you'll need to add it here. So perhaps there's something that you need to pay right up front that's not included in your 10 years of cash flow. That would include it here. In this case, this property does have a little bit of lease up, but it is included in my Argus runs, so I'm going to leave that 0. And finally, we have lender fees. I'm going to say it's 1% origination, 1% lender fees for that property. So we've inputted the Main Street retail. I'm going to now input the rest of the 3 properties quickly so you don't have to watch, and I will be right back. Okay, so I have now put the 4 properties in. Now, one thing you'll notice that I didn't mention is the model's built in such a way that the formatting is dynamic, and this is so that when you go to print, this model allows for up to 30 properties, right? And so if I were to simply just format for 30 properties, but most portfolios aren't anywhere near 30 properties, it would look ugly, right? So this is formatted in a way that if you add a new property, it will then add a new line for the next property, and that way when you go to print, you're only printing what you're actually using. So here we have the 4 properties. The next thing we're going to do is drop in the cash flows for each property, and that's done here in the cash flows tab. Again, the tabs here in blue are our input tabs, with the exception of the summary tab, which has some inputs, and that is in just, I guess, no color whatsoever. So we have the cash flow tab. So there's 3 cash flows for each property that we're going to need to drop in. The first is our effective gross revenue, the second is net operating income, and the last is the cash flow before financing, or cash flow from operation. Importing these cash flows is not dynamic. So however you do it, in this case, right, I pulled in cash flow statements from Argus, and now I'm going to do just good old-fashioned copy and paste. But however you do it, but right here is where we're going to drop in the cash flows. This is a 10-year analysis, so it gives us 10 years of cash flows. We're going to drop these in for each property. And so how I do it, let me show you how I do for the first, and then I'll zoom through to the end. I'm going to go here to my Main Street Retail tab. I'm first going to find my effective gross revenue. I'm going to copy this. I'm going to go back to my cash flow tab, and I'm going to paste. Okay, and when I paste there, let's just pull this out so we can see. There are our values. Now these values, again, the cells are always going to be in blue. Even if you paste it and it tries to change the formatting, it's using conditional formatting, so these cells will always be blue. If you want it prettier though, which I prefer, hit Alt-H-V-V to paste, and that will paste without the formatting. And that then keeps the font here the same as what was here before. So let's go back here to Main Street Retail. We've dropped in our effective gross revenue. Now we're going to drop in our net operating income. Copy that. We move back to our cash flow tab, Alt-H-V-V. We drop those in. And finally, we're going to hit our cash flow before financing, which is this line right here, right? Copy that. And Alt-H-V-V. So now we've dropped this first property in. Now you'll notice here at the top, this is doing the calculation to roll up all the cash flows. Also, you'll notice that this is only showing us 4 properties. But if we add a 5th or a 6th down here, and you can see the formulas, down here it will automatically then add those properties. And that way, again, if you were to print this, you can print it and you're not printing just empty cells that have been formatted to include data at some point in time. So I'm going to pause and paste all of my values in so you don't have to watch, and I will be right back. Okay, so the cash flow, the raw cash flows have been dropped into our model. And now our inputs are done. So let's go ahead and take a look at what this portfolio does. We come back to here to our portfolio summary tab, and it's going to give us the information about the portfolio. We have almost 550,000 square feet of net rentable area. Our weighted average occupancy across the portfolio is 90.4%. This is our purchase price based on the prices that I put in for each property. We have no upfront CapEx. This is our acquisition cost. This is our all-in basis, which is our purchase price plus the acquisition cost. I have a going-in cap rate, which is our year 1 NOI right here, divided by our purchase price. That's the 6.64. So over here on the market cap rate, I'm going to go ahead and drop in 6.65. Again, this value, your market cap rate value, you're going to know that because you'll be in your market, or you'll have professionals working for you who can help you derive that number. But in this case, to be simple, I'm going to say that my going-in cap rate is what is market. I have a price per square foot on this, so we'd assumed replacement cost at $250 a square foot. Well, we're buying this thing at about $200 a foot, so it looks like we're buying for less than replacement cost. Then we have here our year 1 NOI, and we have our year 3 NOI. Then this is the number of properties we have. It also shows us what our financing assumptions are in terms of loan amount, what we're paying in lender fees, then what's the net proceeds of those, and the equity required. Our weighted average interest rate, years of IO, ammo. Of course, the weighted average is going to be equal to the amount we had because this is one loan collateralized by the different properties. But if we had different terms for each property, then this is going to give us kind of that weighted average. And then next, before we get to the portfolio metrics, let's go ahead and look at our portfolio level returns. Now this is the module that's calculating the roll-up cash flows, and it's giving us here we have an unlevered internal rate of return for each year. Okay. Now you'll notice we have an error in year 10. Now I think what's happening here is in Argus I only modeled 10 years of cash flows. But right now our assumption is that we're using year 11 to calculate our terminal value. So in order to fix this, I'm pretty sure, I think we're going to come back here, we just put this as 10. Okay, yep, that to fix it. What it does, I didn't have an NOI value to cap our exit. right? So because of that, it was capping a 0, and it was giving us an error. Now that should fix it. So also what it did, it got rid of that column there because I had not modeled 11 years in Argus. I'd only modeled 10. We're having to cap our year 10 NY to come up with our exit value. But again, so you can look through this, you can print this. If you're interested, down here, our internal rate of return calculations are being done here. And I hide that just to make this pretty. So this is our portfolio level. The next thing you're going to want to look at is your property level returns, right? So again, this model is built so that we don't have a million tabs. And in order to do that, I use this scenario tool. So we have a drop-down menu right here. And this drop-down menu is going to show you the properties in this portfolio. Now it should always start out as all aired out because the property that's in right now showing as the active property is not even a property that's in our portfolio. So we're going to go ahead and just choose any property here on the list. And for now, Main Street Retail, we see the cash flow statement, our returns here in terms of unlevered IRR, our equity multiple. We see the portion of IRR that's coming from income versus coming from the sale. We have our debt service coverage ratio, our debt yield. We have down here, again, our net cash on sale, as well as our net gain. We have our well, here's our levered internal rate of return. You see here our levered cash flows. Here's our average cash on cash return. So you can see by property, that's Main Street Retail. We can come here to 110 Broad Street. We can look at Hollybrook Town Center, and you can see each one. You can print each one. And that's great. Does it all on one tab so that you're not jumping between tabs to see the returns for the property. The other thing, though, you might want to do, might want to see how each property compares to another. And so down here we have the Property Metrics tab. Now, in order to make the property, this is a data table here, and the very first time or each time you make a change to any of your inputs, you'll need to come in and you'll need to recalculate this data table. Now over here in our help boxes, it tells you press F9 to update this table. And so I'm going to go ahead and press F9. And the table's updated. And now we can see how each property performs relative to the other properties. And this will give us a feel for which properties are underperforming versus overperforming relative to the portfolio level returns. And we have these different metrics that it's comparing. And you can go ahead and look through this. And then again, you can print this out, include it in your report alongside the portfolio level information. Next, we have debt. You can look at this or not, but this is going to give you a feel for what your debt service is by property. So we also have here the loan balance for each year. Now, if you remember, this is 3 years of interest only, and then it begins amortizing. And that's why you have here our loan balance stays the same. Now, notice this right here is blank. It's really not blank. That's a formatting issue in my conditional formatting. I'll fix that so when you use the model, this will actually show up. But you can see there is a value here. It's just hidden because of the formatting. Let me show you. See, that's the value for this cell. So I'll go ahead and fix that. And then so you can go ahead and look at how the financing is running for each one of these properties, what your payoff is in each year, etc. So let's come back finally to your portfolio summary. And we see here our purchase price versus our DCF value. They're pretty dang close, which is kind of interesting. We have then our replacement costs, and so we're seeing that we're paying less than replacement costs, at least based on this assumption. We have our unlevered IRR of 8.5%. We also have unlevered equity multiple, average free and clear return, which is, think of that as cash on cash, but unlevered. And then our levered returns here. And lastly, then our minimum debt service coverage and our minimum debt yield over the analysis period. So that is my real estate portfolio acquisition model. If you have questions, please let me know. There may be errors in the model. I haven't tested this professionally. I built it specifically for this purpose. So if you find those errors, let me know, and I'll go ahead and correct those. And thank you for your time.